Good morning, ladies and gentlemen. Well, the risk dial is actually at 82, so still very much in risk on. You will have noticed that for the past couple of days, the site has not been updating. We continue to have these difficulties, but the good news is that I've agreed with a web developer to do a once-over for the whole site. So in the next couple of weeks, while I'm away on holiday, the whole thing should be basically rejigged, and we will have a site which can be updated with thousands more stocks and ETFs, especially from the EEM sector, which I think is going to rip in the next couple of years. And we will have something much better, which works far better than it has up to now. So that is the silver lining. I apologize. Please stick with it. Stick with me for the next couple of weeks while we figure this out. But I am very optimistic that we'll have no more problems in a couple of weeks. Having said that, the risk dial is working. It's giving good signals. We are very much in risk on, and let's examine the reasons behind that by having a look at what the bonds and the yield curves are currently saying. No change in view in the 2s, 10s. I still think that at some stage it breaks down convincingly through this 98 area and heads its way down towards the 50s and 60s. I think it's going to be quite a large move. I'm a seller of every time it goes up close to 120 basis points. I still think that we have an opportunity to see that kind of price action over the course of the next couple of weeks while I'm away, and eventually to break down through the 98 area, as I keep on saying. There is no reason for the 2s area to become bought. The economy is very strong, inflation is very strong, and therefore I think that sooner or later you have the pressure at the end, at the 2s. We will examine each component of the yield curve, but I think that the 2s area is the one that is by far the most vulnerable. Well, the yield curve is flattening, and it keeps on flattening, but I don't think there's very much in it. This is a weekly chart of 5s, 30s. I would have thought that something like 57, 58 is achievable, but I think the risk reward from here is very much again to the downside, back down towards the 105 area. And that is why I keep on not being able to buy NDX over SPY, even though all the spreads, as we will see, are still positive for the technology sector. But I just don't see how there is that much more in the 5s, 30s. It is basically, this is a daily chart, it is basically still flattening, it's still in this trend, but I really think that we're playing for peanuts up here. This was the trend. Up here, you're talking 5-10 basis points max. And the one that is, a little bit worrying is that the 10s, 30s are not correcting at all. Could they go to something like 30 basis points? Absolutely. Could they go to something like 25 basis points? Absolutely. But I really don't think that they're going to go a million miles from here until year end. It's just not worth it to me. I just don't see the where this huge pressure is going to come from. Does the market need duration? Yes, it does. But I really think that we are more likely to be stable at these levels rather than continue this trend. If we pan out in the 2s themselves, you can see at that we are really at critical levels. I think this area here around 54, 55 basis points is absolutely critical. The day we bust through, we are going to go probably, all the way here to the 90s, at least. And that is why I think the 2s, 10s is the vulnerable part. And that is probably why the whole yield curve, as I showed you just now, is doing what it is in the 5s, 30s, because it's anticipating a big flattening in the very short end. To me, 2s are just walking risk. Can we have another dip down towards 35? Yes, I'm hoping we do. A repeat of something like this. But with inflation as it is, with CPI where it is, the danger is actually for a big move up in 2s when the Fed finally gives up and accelerates its A, the tapering, and B, more or less the market has a fixed date for Fed liftoff, which personally I still think is going to be in Q2 of 2022. But the dangers are that it's brought forward. I don't think the Fed can sustain another more than 2 big CPI prints and big employment prints combined. I think at some stage they throw in the towel and the market goes up towards 90, giving us a big flattening in 2s, 10s, and not much in 5s, 30s, not much in 10s, 30s. Why do I think that Fed is going to, at some stage, have to accelerate A, tapering, and B, bring forward rate hikes? Well, it's because these charts keep on looking dreadful, and that is, this one is the 10-year break-even inflation rate, which is making new highs. And there's absolutely no reason to expect that it's, if we zoom back, there's absolutely no reason to expect that this will not continue up. It just is making new highs all the time. If we have a look at the 5-year forward inflation expectation, which actually our friend Jay Powell has told us is one of his favorites, it's not a downtrend, is it? It's more likely to break up than break down. We're at 235 as of Friday, basically 2-3 basis points away from breaking out, 5 basis points from breaking out. The odds are that it does break out. So while these chart formations, and let's, you can set up your own account, while it's looking the way it's looking, I think that all the odds are is that we go up towards these levels around 280. And at some stage, the Fed is just going to give up and bring forward those rate hikes. And at some stage, the 2-year note is just going to get thrashed. And I mean, it's a very big move that I'm looking for. I'm looking for a move to peak in the 90 to 100 area. The 5s basically, they're reacting with 2s. So you can see really that my 116, 117 area that I said one should not buy it before is, more or less the right one. Can it go up towards 145? Well, only if the 2s lead, I believe. It's more likely to remain stable. It's going to remain more stable than the 2s. And unless the 2s break the 54 area, I really can't see too much pressure on the 5s. It's much the same story if we look at the 10s and 30s. This is now a chart of the 10s. And really, every time we get to 169, 170, we are toppish. That is because the 5s, the 10s, and the 30s have already reached the levels that we were at before the pandemic. and really it's the Fed that's holding back everything. The only way that 5s, 10s and 30s are going to start breaking up above these pandemic levels is if we are absolutely convinced, the market is absolutely convinced that the Fed is not going to raise rates. And then the curve can really steepen because inflation can rip and the market can anticipate the rip in inflation. But that at the moment I think is just too soon. I think we all know that the Fed can control inflation. All it has to do is accelerate the tapering and the hikes. So that to me is really not very likely. And we can see it in a chart of the 30s that basically we are just bouncing off the lows that we made back in July, tried again in September, and now we're trying them again and we fail because every time we get down to these levels we see that CPI is actually accelerating, and really, to break through these levels we should be anticipating something like a recession rather than what we have got, the situation that we have. And that's very well illustrated in this chart of TLT. If we enlarge it, we can see that we have very much a ceiling around this 151, 152 area, which is where we traded the previous lows and when we broke down from. And every time it gets down here towards 143, there are buyers because the market still needs duration. This period of stability between 143 and 150, I think, will continue. And there is no reason to expect the 30s to make a big move unless the Fed does something silly. Or doesn't do anything, but how do we know it's not going to do something? And that is why we're going to have this stability. We would really need something very strange to come out of the Fed for the 30s to start leading and TLT to start leading on the downside. I often ask myself, when are the twos in the US going to be able to go higher than those 54, 55 levels that I showed you? And I think the answer is when the Schatz, which is this chart here of a 2-year generic German bond, gives it an opportunity. And it's no longer doing this, which is what it did when the ECB basically says absolutely no way are we hiking rates. Well, I think my level is very clear. It's around 78, 79 basis points. Once we're there, all the pressure that the QE that the ECB is doing stops going into the US as well, because every central bank that does QE doesn't do QE only for itself, but via the foreign exchange market, the mechanism is transmitted to other markets as well. So the more QE there is from any number of central banks, that mechanism is transmitted throughout the world. I think that once we reach this level in the Schatz, all the pressure is going to return to the upside. Not that I think the Schatz is going to go a million miles. Do I think it can go back to these levels around 65-ish basis points? Absolutely. But that to me will be the signal that the downward pressure that the Schatz is exerting on the 2-year is going to be over for quite some time, and the risk then will be worldwide for higher rates at the very short end. So that is the level that I'm looking for to start actually more than, I want to short the Schatz, but I want to short more the 2-year in the US. Before we go into the other 10-years in Europe, I just wanted to show you the differential between US and bunds. So 10-year note against the bund, and we tried again last week the 182 absolutely critical level, and we slightly backed off. There's every chance that this continues a little bit higher towards the 194, 195. I doubt that it's sustainable. I think it comes back down, and my longer term expectations are that it goes a long way down, you know, straight through this 159 at some stage and much lower. So I will definitely be a seller up here for my longer term portfolios. Why do I think that? I think the ECB, I think inflation is a worldwide phenomenon. It's not going to stop at the US. And I think at some stage, cooler heads will prevail at the ECB, and things will turn round. And they will follow the Fed with some kind of a lag, whether that lag is 6 months or 12 months. That is basically what this is arguing. But I don't think that this is sustainable. I think Europe and the US are going to experience the same types of inflationary pressures and continuations of them. And therefore, I think that eventually, when the ECB starts following the Fed, this differential is going to come down. And that is why I think that we are in a funny period where you know, the ECB QE is actually holding down US yields just as much as it's holding down EU yields. And I'm looking for levels that where EU yields tell me that it's probably safe to do stuff in the US as well. So having said that, and I hope you are following my argument, let's have a look at the 5s and 10s in Germany. This is the bobble. I think this is definitely the area to get involved in, around 64 basis points, and that is around 50 in the in the futures. That 135.50-ish, you know, I want to start getting in at 37, but definitely here some longer term options are definitely warranted, and I will write you a piece and post it on the stream, so you have it for the next couple of weeks, and really it would be very well worthwhile doing some longer term options at this kind of level. If we look at the bund, that is nowhere near as clear as I will show you the chart of the OATs later. But to me, the level is somewhere here, around the 36 basis points, something like that. That is my, you know, sort of A, B, C kind of thing, and then we go again. But the clearest chart, I think, is the, get rid of that, is this chart here of the OATs. OATs has been trading its levels absolutely beautifully, and to me the level is here, is between 0 and -7, -8. That kind of area is the area that I think is, you know, when it matches up with bunds, is going to be a very high level of risk reward to short. The yield curve in the in Europe actually has a much better chance of steepening, and steepening significantly, than the US does, simply because the ECB is being so pig-headed. At some stage they're going to have to give up, just like the Fed is going to have to give up. The market is just going to force them. So I think you're talking a much more significant steepening potential in Europe in the short term than in the US. The dollar is doing exactly what it should be doing, and it's actually doing the ECB's job. This is significant easing of monetary conditions in the euro area. We've had a move basically from 90 to 95, and that is a significant easing of monetary conditions in Europe and tightening in the US. What do I think is likely to happen? I think we are likely to trade 96.47. I explained just now in the bond section what is happening to the two yield curves and how the ECB is keeping the 2-year area very much under control. And really, it would be lovely if we got a matchup of the Schatz level to around that minus 74 level that I was talking about, and the dollar at 96.47. That really would match up very well indeed. I think at 96.47, the odds start being that the dollar is in a turnaround phase to the downside. I don't think that this is so much a dollar move rather than a euro move, a yen move, a British pound move. I think the dollar is actually quite neutral, but I think that when it starts getting to these levels, anywhere around between 96.07 and this 90.97 level, so you're talking about, 1% less than that, the odds turn to moves down, and therefore to moves up in Schatz, in Bobble, in Bunds, and that is matching up quite nicely. You can see really that we've had many reactions to this level, which is 96.60, 96.70. That is, you can see how many times we've had weekly highs and lows that went to that level. I think 96.07 is, if we look on the daily chart again, is a very important level, and that is why it's been a much thicker line for years now. But you can see that, we can get into the 96, high 96s without any problem. But the higher we go here, I think the risk reward turns more and more to the downside and a return down towards the 93s. But I think the immediate pressure, and for the reason that the differentials are still being pushed in one way, and the ECB is being very effective at doing that, the pressure is towards, the immediate pressure is towards 96.47 and 96.60 something. In Euro USD, I think this level on the weekly chart, which is 113.05, is actually matches up very well with the DX levels I just showed you. We probably have an opportunity for a couple of weeks of, up and down, but eventually I do see that level, 113.04. I think from there the pressure turns back up towards 118. But we have now very much all the moving averages on the weekly basis turning over. So any kind of retracement level is going to be another opportunity for a range trade. I do think that this 113 level starts becoming bottomish and 118 starts becoming toppish. I think the ECB has achieved what it wanted. It wanted the currency, it wanted the FX market to provide it with some additional easing of monetary conditions, which has happened. So they are quite happy. I don't think they want the euro to go much weaker than this, but I think that they are very happy that it's not in the 120s, and that basically they've got accommodation without having to do very much. So I don't think the pressure is going to be beyond that 113.04. It's, to me, that is an extreme, and I think definitely some call spreads at 113.05 when it gets there in a couple of weeks' time for year end are going to be profitable. And finally, the stability in the longer term bonds has overcome the bullishness of the dollar and allowed gold to break that very important 30-40 area. You know, it's a buy the dip time in gold now. I still think there will be dips to be bought down towards 1830. I think far too many people are getting far too bullish of gold, but it is in an uptrend which could result in a much higher level of the gold price. But I think that in the meantime, it's going to stop everybody out every which way. I certainly think that we will see 1881 and potentially this kind of level around 1913. I don't expect it to be much stronger than that in the short term. I do expect some dips to below 1830 to basically stop people, to stop out the people who have been buying it 1840, 1850, 1860s. But I think it's buy the dip time again in gold. This was the signal that I was looking for. I no longer ever want to be short. I just am looking for levels to get long. And I think any dip below 1830, you buy call spreads. I think that's going to be the trade. And eventually we're looking for the 1950s, 1960s. If we look at it on the weekly chart, and I will enlarge this area, you know, basically you can see that every time it's broken the 1840s, it's gone to around 1912, 1913. I definitely expect those levels, but we are still in a, you know, I'd want it to confirm to me that it's going immediately higher than about 1913. It has to clear that level and close on a weekly basis somewhere around here, around 1950, and then keep on pressuring the upper Bollinger Band. I don't think that is likely at the moment. I don't think the bonds will allow that kind of a movement, and I don't think the dollar will allow that kind of a movement. But it's certainly, to me, it's buy the dip time every time we basically stop people out again on the daily charts. Any kind of move to around 1830, I'm a definite buyer of calls for the move to 1913. Why don't I think that gold is just going to rip? Well, because nothing's really changed in its relationship with DBC. You know, we've had a little bit of a retracement, perfectly normal, but you know, all the moving averages and the longer term ones are very much you know, still pointed down, and I still believe that over the next 6 months or so we will get to the ultimate aim of getting towards 638, when I think gold would really start outperforming the DBC commodities. And I think, funnily enough, that it's this very stability, current stability in DBC, which is, you know, frustrating some people and saying, well, maybe DBC has done everything it's going to do, let's buy some gold instead. And that's probably provoked the little buying spree that we've had in gold. I don't think the move in DBC is over. As I said, I thought that this kind of area would be the natural pause level, but we had this kind of action. That's exactly what we're having. We're allowing the market to move away from the weekly Bollingers, do a little bit of backing and filling, and I think it goes again. So I still think that DBC longer term is a better bet than gold, certainly for the time being. But I still think that what I said, that it's buy the dip time in gold, applies for DBC very much as well. And since DBC is very energy heavy, we might as well have a look at oil. And really here, not a lot has changed. These are healthy little retracements. As long as we are staying above 75 in the front contract, excuse me, absolutely nothing has changed. We can do, a nice cup and handle here and then go again. So I really don't see any, any reason for concern. The reason for concern would be if we started, trading much below 67, 68. That would be a potential reason for concern. But while we are turning all this, this is just healthy retracement. And really, DBC, it's very much a buy the dip in CL, DBC and gold. Copper is really not saying very much. We are basically, returning always to this 4,100 or 4.1735, whatever the hell that is. I really don't see that this is in trouble either. I think the odds are that we at some stage continue higher rather than break lower. And, that is the story of all commodities. I really don't see any difference between oil, DBC, copper. So everything tells me that at some stage we continue higher. When the charts change, my opinion will change. But at the moment, there's absolutely no indicator from any of those that we are in longer term trouble in the commodity sector. Risk assets had a very quiet week. And really what happened is that we returned to the level which was the breakout above the Bollinger Bands, and we bounced off it, and actually we closed above the Bollinger Band again. It's a sign of strength, actually, that is. But what do I think? Do I think we go up immediately? No, I don't. I think that we are more likely to do a period like this. Have a look here. We went above the Bollinger Band and back down. Then we went up a little bit. Went sideways. We went up a little bit, but we kept on coming back to this break of the Bollinger Bands, and then it took a month, and then it went. It's OPEX week next week. It's unreasonable to think that it's going to go below this 46.30 area. We were very lucky, and we managed to buy some there and just trade it. I think it's a continuation of this kind of trading. Where will the Bollinger Band be next week? Well, it was 68, and here it was 55. So it's probably going up 20. Or let's call it 30. 30 higher than 70, so around the figure 10, so previous highs kind of thing. That's the kind of level. Maybe the market goes and takes out the previous highs by a little bit, and that is going to be told us by this 182 minute. You can see where the upper Bollingers are. You can see what the market did, is exactly as I said. This is where we broke above the Bollinger. We went back to it, retested it, back above those, even the shortest moving averages. So, the pressure is going to be around towards 47, 47.10, 47.18, which in ES terms is just above, the base is about 5, isn't it? So, that is all we're going to get, and then returns You know, could this be an ABC? Absolutely, or a flat B? Yeah, that's the kind of thing that I'm expecting. I'm expecting not a very exciting week, with OPEX giving us pressure to probably close on Friday around the 4,700 or just above it, and everybody happy. And that kind of behavior is exactly what we are seeing in the Blue Angels or the forwards. You know, it's just they keep on revising higher these numbers and expectations for the future quarters. So to have any kind of really meaningful backup, we need some economic data which says that the economy is much weaker than we are expecting, and therefore it would be reasonable to start readjusting these forward expectations of earnings. We're just not getting that at the moment. In fact, we're getting the opposite. And therefore, it's unreasonable to expect big falls or big moves down in SPX, which are just not purely technical, as I just showed you. NQ also very shallow dip, and basically closed right on top of the Bollinger Bands. The Bollinger Bands aren't going up very much next week, which basically ties in with what we've been talking about in SPX. Mild upward pressure into expiry, and you know, it's unreasonable to expect very large dips, and to be able to you know, that the market is going to offer you that opportunity to buy very big dips. It basically, whichever chart you look at, and this is YM on a weekly basis, you know, it's very much the same. The market is against the top of the Bollinger Bands. It normally waits around a couple of weeks and then continues, which is basically what seasonality is saying. Seasonality is saying it's a strong November, and then you get the Santa rally in the second part of December. I really wouldn't be surprised if between now and say December 10th or 15th, the market did very little and therefore adjusted in time and allowed these Bollinger Bands to move out, which basically then gives the market the opportunity in the last couple of weeks to catch up and really, you know, have the Santa rally, which is so seasonal. As far as the tech spreads, they're very much agreeing with the view that the yield curve is going to remain quite flat. As you can see, we've got the now second weekly closing of XLK over SPY over the previous highs. I think any dips are going to get bought, and this XLK will continue to be a leading sector. We haven't broken up yet in NDX over SPY, but I do expect at some stage it will certainly test the highs that we made at the beginning of 2021 in the first quarter. That actually tells you how boring the NDX market has been in this year. Normally it's a leading indicator. This year it has done not a lot, and that is why I, you know, rather than get bearish, as I explained to you, I'd rather hug the SPY index, because I still think that at some stage this goes higher, but I don't want to buy it now. I don't think this is the right time. I think, you know, we could easily have another dip down, but you just cannot be bearish of SPX, of NDX, while it's doing this kind of a pattern against the SPY. It's much more likely to break up than break down, and that tells you that the market is still expecting relatively flat yield curve for a long time. IWM, or the Russell, is another reason why I'm finding it very hard to believe that we're going to have immediate continuation higher. As you can see here, it's well above the Bollinger Bands, and can one say that this cannot last? Well, no, but I just know that the market likes to stop people out, so I would have thought that a move down to this 234.50 area and does an ABC and stops people out and then goes is more likely than it just keeps on going, especially since it's above the weekly Bollinger. So a few weeks of frustration for people is more likely. But there is absolutely no reason, don't misunderstand me, there is absolutely no reason to get short. I think you're still looking for levels to buy the dip. And that's the way we've been trading it, and that's the way we will continue to trade it, because there are absolutely no reasons to change our minds that we are in risk on. If we look at the other charts, like this is the UK in dollar terms, it's behaving very well. Germany, it's behaving very well. Everything is closing all the time against the weekly Bollinger Bands. And, especially the stocks, it's cleared beautifully and the retracements are minimal, the 42, 43 area, and can just continue higher. I showed you the monthly chart, and I think the 45.12 is the target for the stocks, and I think it probably gets there by year end. There are no reasons that I can see that wouldn't happen. I noticed something that didn't fit last week, and that is that in a week that saw bond yields in the US go higher, US dollars go higher, there was absolutely no downward reaction in EEM. And that is, I wouldn't say it's odd, but I would say it's probably telling. We are actually close at my 52.08 level, and I think that we are going to go higher into year end to around this 56 area. And that is, that's a close to 10% move, right? Why do I think that is happening? I think that when the developed markets are in a bullish phase, but they are very much at resistance and fully valued. I've been saying for a long time that 22 times earnings of $215 is 47.30. Well, that is very much where the market is, isn't it? So the market is fully valued in the developed markets. We have a following wind of seasonality, and that probably allows markets which are technically in a much in a position to catch up to do the catch up. I don't know if you're following my reasoning. Have a look at how stable, really, within a wide range, the EM spreads have been against EWJ, so against Japan. Basically, we've been trading a 10% range in Japan against EM, which makes sense because Japan as an economy is exposed very much to the China and India and that Indo-Pacific region, because that's where they are and that's where most of their trade is. If you have a look how stable it has been basically for years against Germany, okay, so that's not EEM against Germany, this is not so obvious, right? It has been a little bit weaker against the stocks in constant dollar terms, but it's been weakest of all against the US. It's in a continuation downtrend, but it's probably at an extreme, needs to come back a little bit. And that tells me that the odds are that Nikkei, if we have a look at it, what's it done? It's come back, it's filled the gap, and it's going again. I think Nikkei in the next few days is going to test this 30,415 to 30,205 on the weeklies and join these markets at the top end of the Bollinger Band on the weeklies. If we look at EM again, that is a move to around the 54 area. Take out all these stops here. What have we done? You know, basically we've done an A, B, C all the way down to the 100% mark, just below 49. Sorry, just above 49, and now we have the opportunity to go again. I think it's time to probably reload or favor rather EM and Nikkei for the next couple of weeks. And so on to my biases. I really have not changed my mind about the yield curve. I think that if you're playing flattening from the 5s, 30s onwards, you're playing for peanuts. The place you should be playing it would be in the 2s against everything else. And I'm really looking forward. I'm going to leave a lot of bids for option plays, and I will write a piece about that on Monday and post it on the at Charity Hedge. So you have all my levels and my thoughts, because I think that Europe is going to give you some wonderful opportunities in bonds for the next couple of weeks. Risk, I think, is going to be fairly boring with an upside bias into OPEX, and I would favor EM and Nikkei as surprise jokers that will lead it upwards. The VIX I haven't shown you because it's just showing absolutely nothing, and I don't see any reliable signals for it. I think that every time it gets down towards the 15.5 level, you're not supposed to be short of it anymore, but there you go. The changes here are only to gold. I think any dip to around 1830 is now a buy. And at some stage, I'm sure they'll try to go for stops there, but you're supposed to be putting your bids in there and just forgetting about them. I think this complex is still good. This in gold was probably a little bit of a flush to the upside, but I still think that we get these levels and all these dips are buys, and this complex is still a buy on dips, simply because the bonds are not going to come down in yield, but I'm definitely expecting higher yields, especially at the short end. That's about it. Thank you very much indeed, and tweet you on Monday.